Hello, and welcome back to the American Dream Portfolio. Before discussing the primary topic of this video series, asset appreciation, we think that now is a good time to summarize what we have learned from the last few videos. First, we now know that the primary mechanism of hard-working investment returns is appreciation, which is the increase in an asset's value over time, and that the most spectacular examples of appreciation are driven by creative destruction. The contribution of appreciation to the overall result will, of course, vary with each asset. But as we continue our research, we are likely to find that appreciation contributes 2/3 or more to the total. More on appreciation shortly. Second, we've seen that compounding, while powerful, is not the driving force behind strong investment returns. Its contribution will also vary, but, where it exists, it is probably around 1/3 or less of the total. Therefore, when we hear from other sources about the power of compounding, with the suggestion that it is the primary or the only driver of superior returns, we know that these sources are mistaken. Most of the credit given to compounding actually belongs to appreciation. Compounding's formula of interest on interest is fine as far as it goes, but it can rarely compete with appreciation given the low rates of return we receive on interest-bearing accounts under present conditions. Third, we have learned that a necessary feature of hard-working investment accounts is that they contain assets which appreciate in an unpredictable manner. Predictable appreciation does not exist. Predictable compounding does, but it is not strong enough for the results we need. Fourth, while we can accept that the term exponential growth sounds learned and impressive, it offers no information about the rate at which a quantity is growing. In the world of investing, exponential growth would, counterintuitively, imply slow growth for years to come. This is because exponential growth requires a fixed rate multiplier, and as we've seen, fixed rates available today are slow growing for a very long time. With this summary in mind, let's dig deeper into the mechanism of asset appreciation, because it is this mechanism, more than any other, which can result in our becoming financially independent. Let's start by asking the question, what causes an asset's price to go up? Perhaps we can begin to tackle this question by making a connection between appreciation and the economic force we've covered in some detail. Creative destruction. When an economic operation not only offers us something new to buy, but offers us a new way to live, sweeping away present arrangements, and the force of this operation is unleashed upon the investment markets, we would expect massive asset appreciation to result. And we have seen this result play out with companies such as McDonald's, Microsoft, and Amazon. But, in order to harness the power of creative destruction in our American Dream portfolio, we would have to identify these outlier businesses at just the right time. Or would we? Recall from an earlier video that the glory days of the Ford Motor Company, at least as measured by its stock returns, are long gone. Recall, too, that the very early days of Amazon stock provided investors with a gut-wrenching ride. But is there an interval of time with these game-changing companies that provides our portfolio with a long enough sweet spot of opportunity? Let's investigate by digging into the stock price history of two creative destructors we have not yet discussed. Walmart and Nvidia. Walmart came onto the scene in 1962, the same year as its competitor Kmart, though Kmart had earlier roots in another company, SS Kreske. We can all appreciate how dominant Walmart became in the decades that followed. In its sights were long-established retailers like Sears and J.C. Penney. While it's open to question as to which retailer invented the big box concept, there can be no denying that Walmart came to dominate that space in American retailing. So we might ask the question, what window of opportunity were investors granted in order to take advantage of Walmart's spectacular success? Was that window too narrow to be of use? Walmart's stock went public in 1970. Let's assume we wish to stay clear of its first 10 years on the grounds that its stock was likely to be dangerously volatile during those early years, as Amazon's stock was. If we began investing in 1980, were we still too early? Too late? Or what? It turns out that waiting 10 years to invest in Walmart, a company that had long since proven itself a strong competitor, was still an excellent investment choice. From October 1980 to October 1990, Walmart stock appreciated over 4,300%, compared with S&P 500 growth of 150%. If we zoom out to the year 2000, our 20-year investment would have appreciated over 29,000%, compared to the S&P 500's 1,045% gain. What does this tell us? It tells us that if we have located a company that has a strong track record of reaching for dominance, as Walmart had in 1980, then we are clearly not too late waiting 10 or even 20 years after its stock goes public to experience exceptional returns. Can locating companies that are already establishing dominance be that difficult? Let's look at another example. Nvidia. Nvidia is the first company we've looked at that does not sell directly to the public. Nevertheless, since its stock went public in 1999, Nvidia has reached for and achieved dominance in the world of artificial intelligence hardware and a related proprietary software ecosystem. Analysts conclude that Nvidia has a wide and protective moat around its vast activities, which means that competitors must overcome huge barriers of entry to challenge Nvidia's position. And so, anyone with even a vague interest in information technology could have seen Nvidia coming from miles away in 2019, 20 years after it went public, just as McDonald's was highly visible in 1985 and Walmart in 1990. If we waited 20 years to invest in Nvidia, were we too late to the party? Hardly. From January 2019 to February 2026, Nvidia stock has grown 4,823%, compared to the S&P 500's 156%. So it would seem, thus far, that creative destructors like Nvidia and Walmart offer exceptional opportunities to investors 10 and even 20 years after their stock becomes available. We must keep in mind that, during those years, companies such as these become highly visible as they reach for dominance. Information like this will be very useful as we begin to construct the American Dream portfolio. But are the stocks of creative destructors the only ones that provide the appreciation we need to achieve the American Dream? And just how much appreciation do we need? We will continue our analysis of asset appreciation in the next video. See you then.